How to raise capital by selling stock. Many companies, both large and small, decide to go public and offer investors a portion of ownership in their company by selling shares of stock. There are many reasons for this to happen. Sometimes an entry-level company wants to go public because they have plans to grow and expand and need the capital to achieve their business goals. Attracting awareness and adding interest to a company is also a motive for some businesses. For a mid-level business, going public can be a way to bring liquidity to a company, especially when the majority of the operating budget is consumed by the difference between selling stock with private companies versus public companies. When working with private companies, there are a lot of fundraising options available. The first option is angel investors. Angel investors are individual investors who buy equity in small private firms. Another possible funding opportunity is venture capital firms. Venture capital firms are limited partnerships that specialize in raising money to invest into the private equity of firms that are relatively young. Institutional investors are another way for private companies to raise money. Institutional investors are Now let's discuss public companies. They are much more limited in their stock selling options. Their first option is called the initial public offerings, or also referred to as IPO or going live. This is the process of selling stock to the public for the very first time. The second option is called seasoned equity offerings. This is in play with already publicly traded companies. This involves steps towards an IPO. Step 1. Choose an underwriter, a banker, an accounting firm, an audit firm, and legal representation, preferably people with previous experience in taking a company public. This is the step where companies hire a brokerage firm to help set up a prospectus. The prospectus includes the details of the initial public offering. For example, the price of each stock, the date the stocks will begin to be offered, and the number of shares that will be made available. It is critical that CFOs be actively involved in the recruiting and Step 3. Senior management goes on the road to promote their company and explain the upcoming initial public offering, or IPO. Often this tour is called a roadshow and is essentially a sales pitch, including presentations, question and answer sessions, video posts, and small private meetings, along with larger roadshow events. It involves bankers and company executives meeting with analysts, stock portfolio managers, hedge and mutual fund managers to generate interest in their upcoming stock and answer questions. This step involves a series of presentations all over the country leading up to the IPO. A successful roadshow is often critical to the success of an IPO because of the interest and the excitement that it creates around the company. IPOs, ethics, and Facebook. In 2012, there were allegations from reporters and investors that Morgan Stanley, who was hired by Facebook for $176 million in fees to lead its initial public offering, had told its most valuable clients that it was not optimistic about Facebook's growth prospects, thus leaving all of its other clients in the dark.